चाहे कुछ ट्राई तुम्हें जी
Hello, everyone, and a very good morning to all of you. Distinguished delegates, presenters, and participants from SAARC member states and other regions around the globe. Ladies and gentlemen, I am very thankful to all of you for joining us in the SAARC webinar on exploring financing opportunities for clean energy, environment, and energy efficiency projects. My name is Mohammad Umar Mukhtar, and I am working at SAARC Energy Center as Research Fellow Energy, Transport, and Environment. I shall be moderating today's SAARC webinar, the aim of which is to highlight the various financing opportunities and instruments that have been used in developing countries for renewable energy, environmental, and energy efficiency projects, and disseminate the information among the policymakers, regulators, researchers, academia members, and other stakeholders from the SAARC member states. Finance is the engine of development of infrastructure projects, including clean energy projects. Generally, financial institutions show more interest in fossil fuel projects than green projects, mainly because there are still several risks associated with these new technologies, and they offer a lower rate of return. If we want to achieve sustainable development goals, we need to open a new file for green projects and scale up the financing of investments that provide environmental benefits through new financial instruments and new policies, such as green bonds, green banks, carbon market instruments, fiscal policy, green central banking, financial technologies, community based green funds, etc., which are collectively known as green finance. However, developing countries, notably those with underdeveloped financial systems, face particular challenges in financing clean energy development projects. In today's webinar, we will be discussing those challenges as well as appropriate financing instruments for developing countries. The possible participants of the webinar could be from relevant government departments, research organizations, academia, associated industry, and entrepreneurs, etc., specifically from South Asia. It is my pleasure to inform all of you that Mr. Mohammad Naeem Malik, who is the director of SAARC Energy Center, has also joined us in this webinar. We are very thankful to you, sir, for taking out time from your busy schedule to attend this event. I am also extremely grateful to our panel of presenters. We are joined today by Mr. Amir Zafar Durrani, CEO Re-Energy and HAR, Mr. Sandeep Kumar Mohanty, Associate Director PwC India, and Dr. Rahul Tongia, an adjunct professor at Carnegie Mellon University. I thank all of them for their enthusiasm and willingness to participate in our webinar. I shall introduce them in detail before the start of their relevant sessions. Dear participants, you will have the opportunity to ask questions to presenters by typing your questions or clicking to the raised hand option into the attendees panel of the main window of GoToWebinar software. You may send in your questions at any time during the presentations. I shall be collecting these questions and address them during the question and answer session at the end of each presentation. Additionally, you will also have a chance to share your views at the end of the webinar. Now, I would like to request Mr. Mohammad Naeem Malik, Director, SAARC Energy Center, to deliver his welcome note.
Thank you, Umar. Dear friends, participants, and presenters of the webinar, Assalamu alaikum and very good morning. I am Naeem Malik, and I welcome you all to this webinar on exploring financing opportunities for clean energy, environment, and energy efficiency projects. It's a great honor for me to speak to you on this occasion and over an important topic for the SAARC region. Dear participants, first of all, let me briefly speak about SAARC Energy Center and its responsibility. SAARC Energy Center is a regional center of SAARC Secretariat and was established in 2006 to promote development of energy resources, enhance energy trade in the region, develop frameworks for renewable energy resources exploitation, and to promote energy efficiency and conservation in the 8 member states of South Asia. We do that by commissioning various research studies, organizing workshops and webinars, holding dialogues, and helping find the solutions of the regional energy related challenges for the South Asian member states. The center is expected to translate the energy vision of SAARC leadership into reality. Therefore, a governing board equally represented by the energy professionals from all 8 member states was constituted to guide and supervise the center. The day-to-day functional control of the center lies with the SAARC Secretariat. Pakistan, being the host country, shares the major portion of financial budget. During the last 10 years, the center has emerged as a vibrant and effective SAARC institute, which was which has played its role in all regional level energy initiatives. To date, the center has carried out almost 150 interventions. The reports of these interventions are available on our website. Dear participants, renewable energy financing scaling up in developing countries is necessary to meet climate and sustainable development goals. These projects in developing countries face multiple challenges that can hinder the development and uptake of renewable energy. The challenges include lack of market transparency, lack of financing, inexperience in project development, and lack of relevant information on regulations, markets, and resource availability. Project developers often choose wrong financing instruments and models which are not in alignment with the local conditions and market of a particular developing economy, which leads to project failure, thus making it difficult for new investors by eroding their confidence in the market of the developing country. In such a scenario, it is very important for project developers to properly identify and choose the type of financing instruments. A wide variety of financing opportunities exist for project developers. However, these financing instruments must be chosen by taking into consideration the capability of local agencies to manage them effectively and efficiently, and giving due attention to the local financing markets and understand uh, and use for those instruments. Therefore, through this webinar, SCC aims to highlight the various financing opportunities and instruments that have been used in the developing countries for renewable energy, environment, and energy efficiency projects. In this webinar, we have the honor of having distinguished South Asian experts. I am delighted to invite Mr. Amir Zafar Durrani from Re-Energy Inha, Mr. Sandeep Kumar from PwC India, and Mr. Rahul Togia from Carnegie Mellon University. I am honored to acknowledge the great cooperation and support extended by all of them for this webinar. This depicts their commitment and resolve to the cause of energy and environment. In the end, I once again thank you all for joining this event and wish you all a very comfortable learning and knowledge sharing experience through this webinar. I thank you all very much and best of luck. Thank you. Thank you very much.
Thank you very much, sir, for your welcome note and for explaining the role of SAARC Energy Center. Now let's quickly move on to the presentations. Our first expert, Mr. Sandeep Kumar Mohanty, has over 10 years of professional experience in management consulting and has supported a number of Indian firms, global utilities, and private equity clients on financing strategy, market research, financial modeling, commercial contract review, and strategic advice on growth, market entry, and expansion. He has worked extensively in the renewable energy financing space in projects such as number 1, bond market study in Bangladesh for Guarantco, number 2, advisory services for UK India Fund for catalyzing investments to Indian infrastructure space, including renewable energy, energy storage, electric vehicles, and smart cities, as well as early market engagement for a £500 million UK-India Green Growth Fund. Number three, advisory support in assessing solar power market and opportunities in India, Bangladesh, Sri Lanka, Vietnam, and Indonesia for light source. Number four, regulatory and commercial due diligence of a 750 megawatt solar park in India for IFC. In addition to India, Mr. Sandeep has worked on engagements in Nigeria, Uganda, South Africa, Vietnam, and Cambodia. He has a master's degree in business management from Xavier Institute of Management, Bhubaneswar, specializing in finance and strategy, and is a graduate in computer science engineering from University College of Engineering, Burla. Mr. Sandeep will be giving an overview of financial instruments for renewable energy technologies. So on to Mr. Sandeep. Hello, Mr. Sandeep. Can you hear me?
Hello.
Uh,
Hi, we can hear you, Mr. Sandeep, and we can see your screen.
Sure. Uh, Thank you. Thank you very much, all of you, for attending this session. And I'm really thankful to SEC for this, for organizing such a wonderful session and allowing us to be a part of it. And we are very honored for that, for this occasion. Now, with this, I would like to kick off without wasting much time on today's topic, the first topic that I'm taking up, that is financial instruments for renewable energy project. Now, the idea of this entire presentation and the way that we have structured is to move from what we have today, uh, how are renewable energy projects getting financed, what are the different kinds of financing resources that is available, and possibly looking at a way forward towards more innovative means of financing, which can help address the issue of bringing in capital into the SAARC nation, addressing the issue of recycling capital which is already invested, and finally on the cost issue, because that's one of the most important drivers for renewable energy financing. It's echoing. Yeah. So just to very quickly go through the agenda today, the first section, we are just trying to set up a context for the entire presentation. The second section, our focus is on looking at the traditional financial instruments that we had in the market, mostly the debt and the equity side of it. We're going to talk about the guarantees a bit, because we believe that future, as we move towards more offshore funding, looking to bring in pension funds, sovereign funds into a country, guarantees can possibly play a much greater role. And finally, we'll try to finish off with some of the innovative financial instruments. Yeah. So the need for renewable energy finance today. Now, increasingly, what we have seen in many of the SAARC nations is that the governments across SAARC nations have committed towards growth of clean infrastructure, and most notably renewable energy. The other major trend across SAARC nations is on affordability. So not only we want to invest in renewable energy technologies and clean infrastructure, but we want the infrastructure and the utility services to be to be affordable by common public. And the plans are quite large. So these three trends, leads to the entire requirement that we need capital both domestically as well as internationally to meet our local development and growth needs. if we look at, what could be the major drivers going forward, um, for both, for the renewable energy financing, over a course of period. Firstly, we believe that the way that plans are, the way and the size of the plans that are set by different governments across countries will play a huge impetus in driving cheap funding towards the SAARC countries. Government policies on how are the risks of both developer and financier protected will again have a major role in determining how much and how the funding is going to happen. And the third important, aspect is around the legal, the taxation, and the overall investment environment in the country. So we might have, so there could be occasions where we have the policies in place, the market looks potential, but we do not have enabling laws to actually help drive investments forward. So these three criteria is something that any financier, any investor across the globe will be looking at. Just to give you, a broad overview of the different financial instruments that we'll be covering. So we are covering on the pure financials. So if you look at, how a typical infrastructure projects could be financed, there are broadly three sources of funds. Two is what we are covering here already, the debt and the equity, that's the credit side and the investor side. And the third element, which in past has been quite popular, is the grant element. So the difference between all three is that credit is more sort of secured, first try to cash flows, but assured income. There is no upside to it. Equity comes in with developer risk, but has a considerable upside. He's the owner and the promoter of the company. Grant is something which is a zero cost fund, often given by public utilities in order to minimize the cost of procurement. So typically, in theory, grant is something that helps, that should be infused in sector which are not affordable today. So that's how the evolution of the three sources of funds has been. Yeah, here we have also tried to cover guarantees, because the more and more we are going to look to tap global finances, need uh, we would need to provide risk assurances to different investors, because people coming in from let's say a UK or Canada have different risk perception of the different SAARC nations. And they're, even with the same, let's say, the same legal environment, the same policy environment, their perception could be completely different. So it's important to have guarantee products which actually comforts them in terms of the overall, or basically minimizes their downside in long run. So that's very important to have foreign capital coming into the country. And finally, we'll conclude with some of the innovative financing instruments that have come in, most notably green bonds. So green bonds has been quite popular, especially for a lot of Indian companies who have been Indian renewable companies have been raising green bonds for the past couple of years. The banking sector, the NBFIs have also been raising funds through green bonds. Infrastructure Investment Trust, which is very similar to REITs, which is popular across the world. Here, basically, this is a secondary financing mechanism wherein if you have an operating asset, you could actually sell it to an InvIT structure. There are some taxation benefits for having an InvIT, and it allows the primary investor to recycle his capital and earn some return without maybe going for a full-fledged IPO. So this is one of the mechanisms for exits actually. Carbon financing, small scale project financing, asset backed securities, and microfinancing. All these four, not that they are all of them are novel concept, but not very, largely utilized across the SAARC nations. But these are for small size projects for differently structured projects. These are for other innovative instruments that could be explored going forward. So we'll start with the traditional financing, and we'll start with debt because about if the project is about 100 million, roughly anywhere between 75 to 80% of the project cost comes from debt. Now, typically, what we have seen is that debt financing across major SAARC nations is primarily dominated by commercial banks. There are specialized NBFCs who provide also senior capital, and some of the multilateral agencies like IFC have played a very prominent role in funding, in also providing debt capital, at least during the initial years when the renewable energy was but not very affordable and it was just about to catch up. So, in debt side, what we have seen again is that the advantage of debt is that it comes at a lower cost typically, and the other benefit that we have seen is that most of the participants understand the tenure issues with an infrastructure project. So typically in countries like India, etc., loans are available for a very long tenure, 15 years, 17 years tenure. In some other places, we have seen that this often, with at least with the domestic commercial banks, we have seen this could be an issue. For example, we were exploring debt market in Bangladesh. We realized that tenures, having a long tenure loan there is often a challenge. So broadly, most of the banks and the NBFCs understand the requirement of a longer tenure loan. They understand the requirement of low cost loans. So these are fairly at least available in all of the SAARC nations. The second kind of instrument that within the it's kind of a hybrid security is the subordinated debt or the MES financing. So typically, what happens if you look at any of the big renewable platform which has grown to a gigawatt size, they to start with they would have limited equity capital. So the lenders provide 70, 75%, 80% of the capital. The rest 20%, often to grow at a quicker rate, they find that gap there. So that's where when they rely on subordinated debt or MES financing, which is kind of a hybrid security between debt and equity, typically comes with a shorter tenure of about 5 years, and the cost of funding is normally higher than that of debt. So there are a number of traditional banks as well as a lot of private equity funds. Initially, when they invested in renewable, the money had come in through subordinate or the MES financing route rather than pure equity. The reason being, this assures them that they have they have the right to cash flows before the equity holders. It also gives them may not be as high as returns of equity, but at least higher than what can be offered under debt. So MES financing actually had played a great predominant role in the development of the overall renewable market, especially in India. That's what we have seen. The next element is a flow, of course, on the public funding and grants. This we have discussed, but slowly we believe that as renewable energy is approaching grid parity, in most cases it's more competitive than the conventional power. We believe that public funding and grants in its original form, where hard cash used to be invested or a viability gap was being provided, that is not needed. We need public support in probably a different form, in forms like guarantees, which we can discuss later. But the traditional hard cash route of public funding and grants is something we do not exactly need in renewables at this point in time, given that it has already achieved a certain level of affordability in the SAARC nations. Equity financing. So post debt equity financing, again, most of the investors or developers face the issue of having limited capital. So there are a lot of other kinds of financial institutions like venture capitals, private equity funds, infrastructure funds, and pension funds play a very, very prominent role. The difference between each of these four, that is venture, private equity, infra, and pension fund, is at what time in the company's life cycle do they invest? What is their expected returns, and what is their investment tenure? So typically, a venture capital or a private equity fund will be okay, will be more acceptable to funding a company which is just starting up in renewable space. Their exit horizons is about 5 years, so they expect that within 5 years they are able to, make it big enough to have an IPO or an InvIT or a secondary sale exit. The return expectations are again high. Typically, we have seen it is the return expectations are over 20% in domestic currency terms. Compared to infrastructure and pension funds, typically these two entities invest when the company in which they are looking to target to invest has grown to a sizable to a sizable quantum. So it should have a good pipeline. It should have some operating assets to actually interest these companies. And these funds, the infrastructure and pension funds, have a much longer term horizon. They look at something around 7 to 12 years of investment horizon. And typically their return expectations is slightly lower. They're comfortable with a 13 to 15% exits as well on a cash to cash basis. So to start up, we need a venture and a private equity. For growth, we need an infrastructure or pension funds. That's how we could easily classify them. Especially on the pension funds, because globally these are the entities who control large amounts of capital. There has been quite a bit of interest from pension funds in Canada, CPPIB, CDPQ, the two of the largest, to invest across SAARC nations. Then, possibly a slightly different type would be sovereign wealth funds like GIC and ADIA, who have again made massive investments within the renewable sector over the couple of years. So pension funds is a huge capital that overall as a region we need to tap in if you're looking at affordable growth in long run. The next slide just talks about again the differences between all the four different types of equity capital. And we have also listed down few of the transactions which has happened across renewable sector. And if we just look at the quantum of investments that have been made by some of these pension funds, and this is what I was iterating earlier, GIC and RDI investing $450 million, CPPIB $250 million. The amount of the quantum of investment is huge. So these guys, the pension funds, the infra funds, have huge capital that we can tap in. But we need a certain track record to be able to tap them. So that's something there. Now, we spoke about earlier that how grants are, today a pure cash grant is something that is not very important for the overall sector, because we have reached a stage when renewable energy is more affordable than probably conventional energy. But what remains, and where we actually can get a lot of public sector support, where these sectors across SAARC nation can get public sector support, is in form of guarantees. And this guarantee is actually one of a primary enabler on getting some of the large pension funds, infrastructure funds get interested in funding renewable projects in the SAARC countries. Now, a couple of years back, we were doing this study on how the public resources can be used to channelize or enable more private investment in the sector. And some of the output of that study is something that we wanted to talk about. So one is, of course, talking about government guarantees. So when a foreign investor is looking at a specific country which is not its domicile country, their view of the country is quite different. They view that there are political risks, that they cannot underwrite the legal risk. They cannot underwrite the risk of appropriation of assets. It hasn't happened mostly in many of the SAARC countries, but globally it has happened. Currency risk is a major issue because most of the investors actually raise money in dollars, and they get the revenue is in the local currency across the different countries. So there is a currency risk that they take up. There is also a return risk that they have because the way that LIBOR possibly might move globally might impact their cost of funds, whereas their returns is often based on domestic pledges. So these are some of the risks that typically macroeconomic risk that many of the investors cannot recover. So this is where they look at government support to actually, or government support or guarantees, which can come through government, as well as there are private multilaterals who provide guarantees or line of credits, which can be helpful in mitigating some of these risks. And we have just cited a few examples of guarantees. So government guarantee, we have talked about one of the ADB project in Micronesia, wherein a government guarantee actually was put in for any late or non-payment of loan obligation. Similarly, political risk guarantees. So especially, and this is more prevalent for states which uh, which are not democratic and which are not viewed as stable regimes, there often the foreign investor would like to have some sort of political risk coverage. There are a lot of multilaterals who kind of offer political risk guarantee products as well. This is, of course, the biggest item that we as a SAARC region are concerned about. That is the currency risk guarantees. So for most investors, as I explained, they raise funding in dollars or pounds basis their domicile currency, whereas they're investing and getting returns in the local currency here. And the currencies in the SAARC region are mostly, they're not stable currencies, so they are quite prone to wherever they are not completely marketable, they are prone to variations in government policies. Wherever they are completely pledged to the market, they are more prone to market risk because these are developing countries. So this is bound to happen. So most of the large pension funds, infra funds, they look at some sort of protection towards currency risk guarantees. And our also analysis showed that often public sector entities are well placed to do a risk at the centralized level. This reduces the overall cost of providing a hedge product, and B, it also helps to provide a lot of comfort to the overseas investors coming in. This has been particularly very, very prevalent in South American countries who have been known for their PPP initiatives. So many of the countries like Argentina, Peru had put up a structure wherein there is a public fund which kind of supports currency risk movements for any of the overseas investors. So this is something that we could collectively target and look to, especially on how to manage this currency risk, and if collaboratively we could have a company or a fund providing these services to upcoming renewable companies. This would be actually a great help for the development of this overall sector. And finally, the last section, we'll just cover the innovative financing instruments. So green bonds. So green bonds are, this was made popular in both US and UK. The way that it is. So there is a first. I need to stress upon the fact that actually, while green bonds have become quite popular as a labeled product, but in reality, there is no clear-cut demarcation as to what comprises of a green bond. The general idea is that proceeds from an green infrastructure project or a carbon neutral or a negative carbon project, that proceeds or cash flows can be utilized for raising green bonds. The idea of the entire process is that people who are, or investors who are buying green bonds, the buyers of bonds in the market, uh, their return expectations is lower because they are buying a more environmentally positive product. In reality, though, this is this is not completely true, is what we have seen. For example, the cost of raising, or the cost of green bonds for a typical Indian or a Sri Lankan investor, there is not much differentiation if you're raising a local currency for bonds in the foreign market, or if you're raising a pure pounds or a dollar bond as well. So, so yes, this is a good product, a good idea, but the success of it, in true sense, has been slightly marginal, I would say. The way that this process works is there are authentication agencies who while they are not a mandatory part of the process, but it often helps to basically getting recognized as a green asset. So these agencies basically audit the cash flows that is coming out of an operating asset, and this can only be done for the operating assets, by the way. They look at the cash flows coming out of the operating assets, whether it can be classified as green or not. They kind of authorize it, and their authorization carries some value when you are approaching the market. Typically, we have seen the investors in green bond market, vary from pension funds, from municipal corporations. There are certain municipal corporations in Singapore, Canada, who also prescribe to green bonds. And the issuers from SAARC countries have been typical, while this green bonds is open to any green infrastructure, so you could have a railways or a metro also going in, but broadly, we have seen renewable companies and certain NBFCs who are intending to finance renewable projects are the only ones who have actually gone ahead and successfully raised green bonds from the SAARC countries specifically. So India has actually a lot of private sector as well as public sector companies have made successful listings in green bond, but over the last 1 year it has slowed down a bit because the domestic interest rates have actually improved, and the variation or the margin of benefit that we used to have is not there that much. Again, in green bonds, green bonds coupled with some sort of guarantee products can be actually a great combination and help to bring the reduce the overall cost down as well. The second, innovative product that we want to talk about is InvITs. Now, InvITs as a concept has come in India, but globally, it's a well-defined concept of InvITs. Now, how this kind of structure works is that there is a trust. There's a trust which could be where the units are either bought by public, it could be publicly listed, or it could be also privately listed. It could be offered to a few financial instruments. Now, the operating company who owns renewable assets sells the asset at a predefined valuation to this trust. So what this helps is, this helps to bring in a new set of investors into the market. It also helps freeing up capital for the operating company. And then there is an independent trust manager who basically takes care of managing and operating the asset for the future. Now, the question is, how is it different? Often InvITs have certain taxation benefits. So for example, InvITs might, in most cases, InvITs are the distribution of of dividend from the InvITs is often not taxed. So it is taxed only in the hands of the recipient. There could be other taxation benefits, listing cost benefits, which might be quite helpful. So often this is treated as a secondary platform for sale. Apart from something very similar to, you could do an IPO, you could also do an InvIT. An InvIT is very popular for projects which have a annuity kind of cash flow stream. So and renewable actually classify as that. So this is the second structure innovative instrument which we want to talk about, InvIT. Of course, globally there are similar products like business trust in Singapore, REITs in US, which are offered for different kinds of infrastructure investment. Very similar mechanism. Carbon financing. So carbon financing traditionally, I think a lot of projects across SAARC countries have taken the benefit under the older, carbon financing scheme. wherein they used to get CERs and in exchange of investing in low carbon infrastructure projects in India, in their host countries. Now, this is again, sorry. Yeah, so this is based on the UNFCCC Convention of Climate Change, wherein uh, basically on account the investors, on account of investing in low carbon projects which may end up with higher cost, they get certain credits for the investing in that high cost. So that differential which they have, that is, if they had not invested in a renewable project, they might have ended up paying X rupees, and if they have invested, it is X plus Y. So that Y difference is something which under this framework they're allowed to recover through a mechanism of issuing of certificates, and the certificates is then could be traded. So that's how the entire carbon financing mechanism used to work. We had a lot of hydro projects, even to the extent supercritical thermal projects, which were qualified under this program, and they were able to successfully finance it partly. However, under the new Paris Protocol, how carbon financing will change in its face is something that needs to be seen. Asset-backed securities. Again, asset-backed securities, while it's it's a term which we have taken up from real estate. It's very similar to similar in mechanism to an InvIT, but with slight. InvIT is a specific platform with certain incentives given by government, but this is a more generic term. So here, the way that it works is that the current investor, the cash flows that they are getting from the project is then securitized through multiple platforms. Now, by itself, asset-backed securities is not something which seems to be different. But what happens is that there are aggregators who buy different kinds of cash flows and then they securitize it further. So there could be multiple levels of securitization of the same cash flows. That is leveraging, the way they used to do for real estate asset. Similar thing can be done because of the annuity nature of the renewable assets and the predictability of the cash flows, at least on a longer term that they have. The risk in having an asset-backed portfolio for a renewable company is much lesser than compared to real estate, which was more speculative. But again, in renewable case, this could be packaged in multiple sizes, multiple risk classes, and this actually allows us to leverage a single asset multiple times and allows us to leverage our asset much beyond 100%, if I could say. So that's the innovation of asset-backed securities. It has not been very popular. The entire concept of multiple leveraging has not been very popular in SAARC countries, specifically because we want to protect our financial sector as well, and there is a risk associated with that, obviously. So, but this is, of course, this has a great multiplier effect if we are looking to free up capital and reinvest it in other sectors. Microfinancing, again, as the name suggests, is basically providing small size loans. It can be basically used to enable small projects like in rooftop, individual or domestic rooftop space, or it can be used for household solar equipment, small off-grid rural electrification programs. There are a lot of small microfinance companies across SAARC countries which have been playing a prominent role. In India, for example, SKS. Then in Grameen Bank in Bangladesh, for example, they've been playing a good role in terms of driving some of this initiatives. But more and more, the one trend that we are seeing is that aggregation pays off. It makes services cheaper. So while microfinancing is a good trend, should be definitely continued, but when we have an aggregating platform, and that is what many renewable companies or innovators are trying to do, is that when we have an aggregating platform, they're able to bring down the cost drastically. So microfinancing is great in terms of access, but it also comes with higher costs often. So either higher costs or it needs to be subsidized. So uh, the idea is that we need to move up from microfinancing to aggregation or in order to make services more affordable for those who cannot afford it. So that's about microfinancing. And similarly, small scale project financing. Again, here, we were in India, we were trying to put up an initiatives. We have certain large renewable energy companies who control, 1, 2, 3 gigawatts of portfolio. And then we have hundreds of small companies with portfolios of about 10 or 20 megawatt. Now, the problem is that if you look at the cost of fund difference between a large platform and a small company, the difference is as high as 500 basis points, which is huge. So, our initiative was, so basically instead of, for small scale project financing, what we tried to do is that if we could do cluster financing, that is, have 10 or 20 or small companies get together and they get an entire portfolio finance together, that can help again drive down the cost significantly. So this is again one another very similar initiative that we have been talking about. So yes, microfinance and small scale are great, as I described, for access, but we need to move up if we want to make it more and more affordable and penetrative. So with this, I would like to end my presentation, but I'm open for any questions that can come up, and happy to respond to it.
Thank you very much, Mr. Sandeep. It was a very detailed account of the different financing instruments, and you explained it quite well. I'm sure our listeners, they would have greatly had benefited from your explanation. So we have a number of questions here. Let's quickly go through these questions. The first question we have received is that out of different modes you explained very nicely, which approach or option based on your analysis would you recommend for SAARC member states, which is more successful in our part of the world?
I'm just sorry, I just missed out the middle part of the sentence. I think some problem here.
Yeah. So the question is that out of different approaches which you explained, so
Yeah.
according to your own analysis, which approach would you recommend for the SAARC member states, which would result in the more successful financing and which is more suitable to our part of the world?
Yeah, a great question, and obviously everybody would be interested in that. But to be honest, that there is we cannot rely on a very singular source of finance. The reason being that if you look at the region itself, it is one of the most populous region, and the demand of the people here is quite high. So while I'll talk about what has been the general road of financing for most popular or most successful companies around the region. But to be honest, the scale of requirement for the SAARC nations is so huge that we cannot simply rely on a singular source or a singular mechanism of financing to meet our needs. Now, having said that, I think if we look at the financing requirement, it is actually a combination of it has to be a combination of multiple sources, because as I was describing earlier, the different sources of funds want to enter into a project or into a company at different points at time, and they have different requirement of or expectations in terms of returns. So if you look at the most successful projects which has come in, primarily they have started with normal credit from banks and from NBFCs to meet their debt requirement. To meet their equity, they do put in certain equity, but because the gestation period of renewables is small and the companies often target to expand, very quickly. So they rely on MES funding, mostly from small private equities, which for a tenure of 5 years, typically exiting them at anywhere between 16 to 20%. And that's during the growth phase. So once people have a portfolio of about 100 to 200 megawatts, that's when they start looking at the real big guys like a pension fund or infra fund to come in and substitute part of the debt as well as part of the equity. This helps, in recycling the capital as well. But I think the most important aspect of any financing, any financing source is giving an exit. And this is where I think, collectively we have not been very, very successful till now. So we have achieved the growth phase. Our banking sector has delivered. That there has been considerable interest, as I was explaining, from sovereign funds, wealth funds coming in on the equity side as well as a bit on the debt side. But what we have not been successful in is giving them an exit, generating ample interest in the IPO market, generating ample interest through the InvIT market, which is again an exit mechanism. So because any investor who comes in, he is more interested when there is a defined exit, for him, when there is a visible exit. So I think the focus for us is to develop policies and a market which could give exit to companies once they are invested. When they look to exit, maybe after 7 years, 10-year period, we should be the market should be allowed to allow them some exit. And that's where I think we have not been successful through across the SAARC countries, if I may say.
Thank you very much. The next question is that how a political risk guarantee actually works in real, and how the political risk is actually quantified in terms of US dollar.
Okay, so look, there are as far as political risk guarantee is concerned. Now, again, the very, very plain vanilla political risk guarantee is against appropriation of asset. Typically, people go for it when they are not confident about the democratic system or the stable government there, and they believe that the assets could be appropriated at some point in time. So that gives rises to political risk. And more often than not, it is backed on as a portion of your investment that you're committing into the country. And there are certain multilaterals who have been offering this traditionally. But what has changed in terms of political risk guarantees is that now increasingly investors are also looking at legal risk as a part of the overall political risk guarantee or the overall political risk of the country. So while mostly we now have stable governments across the world, but what has really been a challenge for some of the overseas investor is the change in policies, be it on the income tax policy for doing an M&A transaction. We have had certain issues with that in India itself. And this actually has a great impact on the new investors who are coming in. So quite often they also want to protect themselves against any of these legal risks that can come up as a part of their overall coverage of political risk guarantee. The challenge is that there are not a lot of institutions who offer this guarantee as a part of that, because the private sector, the private guarantee entities obviously can't, they won't be in a position to provide this kind of guarantee mitigation products. So the only ones left are few multilaterals. And again, multilaterals, what we have seen is that only in very, very selective case over the last 5 years have they really offered a political risk guarantee. So it's a very tricky situation, but I think the products there are not very, very largely used right now.
Thank you very much. We have a lot of questions, but I'll only ask one more question, and then rest of the questions we might direct towards you in the form of email.
That will be great.
So the next question is, do you have some idea for some sort of regional level solution to direct financing into renewable energy projects? Basically, I guess the questioner is asking about regional scale projects. Let's assume the large scale hydro projects which are in which, let's say, Nepal and India is involved, or Bhutan and India is involved.
Yeah.
So, do you have any sort of idea about the how to which sort of financing instruments to use for that kind of multi-country projects?
Look, I think as far as if traditionally we see some of these multilateral projects which have been developed, they have been mostly done by bilateral funds till now, and partly the reason is beyond simply just providing funds or resources for the project. But if you're really looking at from a resource perspective, I think the challenge in some of these projects could be more on currency and different taxation policies than simply finding a source of funds. So we believe there's a lot of scope for exploring. So A, we need to decide on which currency we want to borrow in. Because if there are multiple countries involved, we do not have a singular currency across the country. So we need to be uh, confident about which currency we are trying to put up the project, and in which our receivables is going to come, and how we are going to manage that. If we do decide to go ahead on a singular currency model, which could be pegged to dollar, to a pound or something, then it's more easier to finance it, because then individual countries can take up risks for individual payments of their own fluctuations, and then it's easier to raise it through open market, whether bond raising, etc. Actually, bonds. See, for infrastructure project, we need to understand, while traditionally we have been relying a lot on NBFCs and specifically the commercial banks to meet our needs. The commercial banks are not the right institutes to fund the infrastructure projects, and bonds are possibly a much better financing source for developing our infrastructure projects. The reason being that bonds, you can have a much longer tenure of bond, which matches your entire concessional period or your cash flow. Whereas banks typically, they are actually borrowing for short term and investing in long term. So not the right combination. A bank financing could be used an intermediary bridge to set up the project, but once it's developed, I think the best way is to go for bond financing, because if you're having multilateral countries involved, I think we'll have the issue of currency, which currency to use, which currency to invest in, and how the payments will happen. So the best and the easiest solution is to have a common currency, a more tradable currency like a dollar or a pounds or something like that, and then using that particular currency to raise funds overseas might help. So I think this is the most convenient route for raising funds for a multilateral project.
Thank you very much, Mr. Sandeep. We have one final question from our director, SAARC Energy Center, Mr. Naeem. He would like to ask you, sir.
Sure.
Sandeep, thank you very much for a very good presentation. We are all grateful for that. One just layman question is that if a private party was to get a loan for maybe a solar project or a wind project, and the financial institution asks for personal guarantee, then what
Mhm.
type of risks are involved in giving the personal guarantee by the private party?
So, that this actually has a lot to do with the overall criminal and legal system that we have in the country, uh, and this is where the differences between here within South Asia, and if we compare us to the West. So in West, typically, there is a very clear segregation of criminal and civil issues. If you look at South Asia, there is a huge overlap. I mean, for example, if a company is defaulting, part of the reason could be, I mean, there are genuine defaulters also, people who have stolen, but part of the reason could be because the company didn't do well. And the entire idea of having company as a separate legal entity is so that, a new investor or innovator doesn't fall into that trap. The problem with I mean, I really do not believe in personal guarantees a lot, because it doesn't give anything, because most of the investors who put in money, they do not have much net worth by as an individual themselves. Most of their money is spread across multiple entities, which are again protected by different entity laws. So personally, even a billionaire might have a personal net worth of some 100, 200 crores. So the exposure of personal guarantees is often limited to his net worth, what he can individually have, his properties, etc., which is not much. Second is that what investors fear today and why they are a little hesitant to give personal guarantees is because they feel that on account of a genuine default, this can be used as a criminal prosecution tool against them, and we have seen some examples of that happening. So we need to be very sure whether if you want personal guarantee. I really don't believe in personal guarantees. I feel that if we really want guarantees, we should have a proper institution providing guarantees. There are multiple who do that. Guarantco, for example, is a very popular entity, multilateral entity in which different European countries have invested in to provide guarantee products. So if you're guaranteed, let the cost build up, but the guarantee should be done in a proper way. But even if, let's say, there is a personal guarantee, we need to have a legal system which clearly defines what comprises, in case of event of default, what comprises a criminal and what comprises a civil case. Because if a genuine default has happened because the company didn't work well, and if you're invoking personal guarantee, it cannot account for a criminal case by the laws of land. So I think it has. I mean, your question is actually so important in today's context, because the implications goes much beyond simple renewable energy or simple issues of financing.
Yeah.
Increasingly, we are looking at commercial banks asking for personal guarantees, but it's a big impediment going forward. So we believe that there has to be a legal as well as a multilateral solution proposed to this in order to overcome this impact.
Thank you, Sandeep. And do you think that these solar projects and
Yeah.
wind projects are entitled for carbon credits?
Oh yes, sir, absolutely.
Okay. Thank you so much,
Thank you, sir.
Sandeep.
Thank you.
Um, Thank you very much, Mr. Sandeep, for your presentation. Now we'll move on to our next presenter, Mr. Amir Durrani. So, our second speaker, Mr. Amir Zafar Durrani, is an acknowledged development expert who is presently involved in renewable energy, technology integration, community-driven development, transport and logistics, trade facilitation, and connectivity. His experience spans over 34 years in 24 countries, of which 17 years were spent in the World Bank Group. His more recent interests lie in solution design and delivery towards low-cost renewable-based distributed energy provision, improving infrastructure and connectivity governance, enabling collaborations in technology-driven social entrepreneurship, and clean logistics and supply chain management. He has spent his last 4 years creating a group of companies around energy, logistics, and IT verticals. In 2015, he founded Re-Energy and Heart, an energy consultancy and services company focusing on business innovation and diversification in renewable energy services. Paidar Tawanai, an off-grid energy supply company, was spun off from Re-Energy and Heart in 2018. In 2015, he also started Secure Global, one of the first 5PL companies in Pakistan, and this year has successfully spun off Transconomy, which focuses on IT enabling logistics and transport. He is working on developing the Village Growth Accelerator program, which looks at accelerating villages clusters into conurbations, 100 cities of 100,000 people by 2050. For enabling this, he has co-founded IdeaGist Pakistan, bringing the world's largest virtual incubator to Pakistan's growing incubation and innovation entrepreneurial ecosystem. The topic of Mr. Durrani's presentation is renewable energy markets, key to financing communities and households.
Hello. Hi, guys. Omar, thank you for the introduction. Can you hear me?
Yes, we can hear you properly. You may please go ahead with your presentation. Your screen is also visible.
Well, thank you very much. So, folks, thank you very much. And Sandeep, I think your presentation actually took away most of my thunder because, but in a way, it's actually good to follow you because I will not spend time on some of the concepts which you have explained quite well. I think that one of the things that I will focus on now because the idea of actually putting this presentation together is that it has a lot of examples of what is done where and what sort of financing is working in under what circumstances. But I think that given the introduction you have already given to the various types of financing and their applications, and I really like the fact, because myself also being an infrastructure person primarily, I totally understand how a lot of what we're talking about today in terms of financing is actually a derivative of what was done with infrastructure. And India, as we all know, has been in the region. I mean, I remember my first visit to the Bangalore-Mysore expressway back in 1998, which essentially was one of the first projects that started looking at long-term infrastructure financing. And I think the other point mentioned by Sandeep on the tenor, I think the tenor is very important, because I think if we took one thing away from his presentation is, before we start thinking of anything, why don't we start thinking of bonds rather than banks? Simply because of the inverted relationship between, for example, the insurance funds and the infrastructure investments. But so basically, what I will now do is, because you've all learned about the various types of financing, I'm going to talk and focus a little bit about the gaps. I'm also going to try and dither the markets which we are talking about when we talk of renewable energy markets. So let's get into it. I mean, before we get into the finance, sorry, my screen is behaving. Can you still see my screen?
Yes, it's visible.
Okay, so I thought that, just to give the conversation a little bit more flavor, instead of talking of the renewable energy market generically, let's talk about it in three parts. And then, you may think about this in whichever way you want, but I think that from my perspective, the renewable energy market for me is one, what I call the large grid offtake market. You have the DG or the community power market, and then you have the household stuff. And as you saw from the previous presentation by Sandeep, that, I mean, he talked about all of them. And so I'm now going to try and disaggregate. And within, by the way, the DG market, there is this discussion about power efficiency which goes on. And, so as you see that most of Africa, the DC market is being promoted, whereas the rest of the world basically bases itself around the current AC market, primarily because the SDGs require the way the energy SDG is currently tabulated. I think the alternating current market will provide a better chance to meet that SDG. So going ahead, okay. So, and again, I think this is a slide where I thought, okay, given the types of markets, we can talk a little bit about the types of financing that, we are generally encountering. And I think we have heard Sandeep again talk about most of these, but just again to regurgitate something he mentioned, but not possibly in this term, is the off-balance sheet and on-balance sheet corporate finance. So I think in the end, when the question came about individuals leveraging finance from commerce, I think he's explained this. So I think the next thing I want to do, and this I think is going to be very educational, is that we try to look at, if you look at all the financing instruments from grants, equity, debt, all the way down to small scale project finance, which he mentioned, it's really a game of balancing what you're trying to do. As you very well know, I mean, if you're trying to get into a market which has increasing risk, and so, for example, he mentioned that in India, there are some 200 plus small companies with portfolios of about 10 to 20 megawatts. So these are basically very risky portfolios for various reasons. And I think one of the things he was trying to also explain is that, aggregating these portfolios, you could undermine the risk, because he told you the difference between what the funds that people are getting for the large utilities, which are $100 million plus, or are in the range of, let's say, 50 to 100 megawatts, are actually, there's a difference of 500 basis points. So in essence, this diagram helps you sift through that. As risk increases, you try to look more for grants. And the guarantees we were talking about, and just to add one thing on the guarantee, I think it was good that he mentioned that the guarantees are not just for against like a revolution or a war or a force majeure or an earthquake or the equipment being destroyed. It's actually more and more guarantees are being sought against changing of policies by governments. And I think that's important to mention. So to me, if we are in a project program financing mode, these guarantees, yes, play a very important role. And secondly, as he very rightly said, that other than entities like MIGA, which is one of the arms of the World Bank, there are very few people offer this. Moving on to types of financing and the associated risks. Again, the purpose of this slide to be put together was to show you that higher risks usually mean higher returns. Now, and we will talk about how this may not be true for the renewable energy market, but essentially, if you look at venture capital, people expect more than 50% higher rates of return, while senior debt at the bank level and mezzanine debt is coming at about 300 plus LIBOR, and the other at about 700. Typical infrastructure funds at about 15%. But I think important to remember now is that therefore this definition itself explains why attracting any of these to the renewable energy market, especially on the distributed side, is riskier and people are more averse. And we'll talk about that as we go along. So first, I think just quick summary on the grid offtake. I mean, in essence, there's the current grid, and as you know, there's the future grid where you have multiple independent generators, all sort of vying to sort of displace the grid supply that's coming to their individual utility. But that's essentially the part of the whole grid offtake game. In grid offtake projects, basically traditional offtakers of the utility serving a retail load, a power marketeer, as in the case of Australia, where power is marketed through multiple countries, companies who purchase power, and then basically there are auctions held, and power prices vary by load, by type of supply, but they are using the same lines. Some of the new important things which are happening in this market are also bulk buyers, and I mean this is an area I will talk about as we go forward. And to talk about the bulk buyers on renewables, this is basically people who are conscious, or basically large companies like Microsoft, Walmart, IKEA, Apple, Facebook, who are and Google, who are big users of energy and have undertaken to have clean portfolios, are able to actually say, we will need X energy over X period, and then they take that and they guarantee. And by guaranteeing that purchase, they're able to allow people to invest in cleaning up the supply of the energy. So, I mean, there's nothing more than that. This table just graph simply shows how these deals have changed between, let's say, over the last 5 years. I think it's important to understand some of the offtake structures, and these offtake structures take usually about 3 to 4 types. One is the traditional power purchase agreement. No need to mention this is standard. What happens? The important thing here is that risk is apportioned equally on the people who are buying and the people who are selling. More time over people who are buying or central agencies that buy. On the synthetic power purchase, you basically settle a contract prior, and basically these power purchase agreements make sure that the risk is more borne by the off-taker, because essentially if the off-taker says, yes, I will buy energy and then goes bust, then you have a problem, and that is by the terms of these kinds of agreements are shorter. You have the hedge. Hedge is again basically a kind of fixed floating. You say amount of power based on swaps. You just put it out there in the market, and it is sold. And again, different power packs are sold over a given period of time. But I think it's important, having explained that, the thing we need to focus on with all these instruments that we've also heard from Sandeep, really what's happening in the market. So I think this diagram for the grid offtake is an interesting one. because it basically shows where the gaps are currently, right? So if you look at from the developer sponsor side, you look at from the corporate or the project side, and if you look at the sort of risk management or what we call the insurance side. So on the project development side, essentially one of the big gaps that we have when we look at renewable energy is the project developers are often underfinanced. And this is why, I mean, there are many reasons for that. Currency hedging is one of them, and our, let's say, lack of availability of proper currency hedges in the country. But you know, the other important thing, gap that we see at the project development is really a widening debt equity gap. And when I say widening debt equity gap, debt actually makes sure you have more money in the bank. It's paid back later. Sorry, equity is means you have more money in the bank. So coming back to looking at proposed interventions, this table, I mean, we tried to lay out, and we thought this was a good table. I don't remember, this was extracted from the IEA, yeah. So, but I think it really tells us the details that what is it, the area where we need to really work on. So, for example, on the financial structuring side, we find that bankers lacking experience. And one of the things that we have found out in the 2.5 years that we have since we did the French study here in Pakistan to help State Bank encourage and set up a sort of a lending portfolio or a pipeline where we basically encourage the local banks to lend in this area, we again find that, you know, bankers have more and more, they lack. I mean, it's easy for them to work on cars, but, you know, again, there is this mismatch, which Sandeep pointed out, is that are we really doing this right? So I think one of the problems that I see, and I want to flag here, is that maybe it's important that instead of going to the commercial side through the banks, maybe we should develop more and more bond instruments as we go along. I think the area which I want to now talk about, and it's really my favorite, is distributed generation. And, you know, DG has more and more people have different definitions. But I think that my definition of the DG is you generate power where you need it, when you need it, and how much you need. So to me, that is distributed generation. Yes, it can be an individual, but more and more for me, DG is a community-based generation where a community takes over. And we'll talk why I make this distinction in this. Essentially, if you think about it, one of the reasons we need to focus on the DG market is that there is a IEA work from 2013, which basically shows that in order to meet the 7th SDG, especially in Asia, more than 40% of this portfolio, sorry, more than 60% of that portfolio will be met through distributed generation or what we call community power or a mix of both. And, you know, the other important thing to remember is that these microgrids or DGs are on solar alone is a $64 billion market as it is emerging by 2030. And again, I mentioned the study earlier where we were looking at, and Umar was very much involved in this study. In fact, these graphs are generated by him, where we looked at the levelized cost electricity, and we found that, you know, yes, distributed generation has a competitive edge in the market depending on how we utilize it. And I think the important point to make here is that every kind of renewable has a niche. So supplying to the grid, yes, for existing areas, urban areas, where basically there are urban collaboration, what we call like, you know, aggregated presence or vertical structures, or you have a concentrated number of humans per square kilometer, yes, grid electricity makes sense. But more and more for rural areas or slightly lesser denser human agglomerations, we are finding mini grids are equally competitive. And so this is an up and emerging area, and that's what I want to talk about. I'll skip these slides, but basically one of the things I want to explain when I skip these 3 slides is that China, and you can look at these later after my presentation, that China over the 10 years period between essentially up until 2015 electrified more than 250,000 villages using distributed generation because they found grid expansion to be very, very expensive. And I want to talk before we get there, before I get into this slide, that what is the mini grid business model, because that will help us define what are the issues in the available financing. Currently, and I just came back from Kenya last Thursday, in sub-Saharan Africa, the current cost of connecting a household to the grid, which is we call the centralized grid, is $1,500 per household. Just try and multiply that by about 300 million people that we need to bring on the grid in South Asia alone. I think tells you that the grid is not the solution. But even more alarming is that currently the average cost of getting the average time of getting a household connected to a grid is about 9 years. So even if we find the money, I don't think people are going to wait that long. On the average, if you do a kind of a Poisson's distribution on that, this means that we will not be able to meet these SDGs for another 100 and some years. So I think that is in itself quite alarming. But getting back to the mini grid business model, you have various parts to the puzzle of financing, right? The revenue collection, the demand management, how you design the tariff, promoting income generation on the end user side. And then very strangely, something you don't do on the full grid model is the end user finance. You also look at the quality of service, because essentially on a mini grid, you are not, being provided by a utility. Not that some of the utilities in South Asia are providing very good electricity, but nevertheless, they do provide. They have standards. So this comes into play very fundamentally. So looking at what sort of financing is available here, again, pretty much the same kind, but in a very different way. The pies are cut very differently. You have grants and subsidies, which obviously the development agencies, local governments, trusts and foundations that essentially provide one-time grants for sometimes mostly just the upfront infra, but not for O&M, which is quite easy to provide through through the life of the project, and improvements are also possible once a project is brought online. You have equity as investors, but more and more we have to understand when we talk of equity here, there are more impact investors. Because one of the things that Sandeep mentioned, and I think it was very telling, is that a lot of like InvITs and all these other instruments, which are supposed to wait for recovering their money, most people don't understand that. But I think one of the things we don't understand is that we are not yet in South Asia fully mature. Well, actually, we've not even started, but maturity is far from it. But on what is currently known very well in the West, especially in the OECD countries and Europe, is this whole idea of social enterprises. Because sometimes capital looks not just for high yields and returns, but more and more capital is now looking to balance the inequity in the world by looking for good or high social impact returns. Yes, the social impact accounting itself needs a lot of work, but it is something where it is now quite known that there are capital funds out there that are focusing primary impact, will wait long, so the tenures will be long, will be fine with 1 to 3% returns. And by the way, given the interest rates currently prevalent in some of these countries, those are very high returns. So they may not be exactly looking just for impact, but at the same time, I think that it's important that the equity investor here and the loans here also are basically going to be from entities where there is at least a feeling that there is some sort of a technical audit of the social impact going on simultaneously. And obviously the guarantees and others, and we'll explain to you why those are needed. But a big risk, which again Sandeep had highlighted, in the larger infrastructure projects is easy to do, but in these smaller distributed generation community power projects for the likes of countries like Nepal, India, Pakistan, Bhutan, Bangladesh, Sri Lanka, the sizes are such that foreign exchange risk really kills. Now, an alternate could be in internalizing the industrial development or producing most of these goods or inputs that we need for the generation on renewables internally, but that's a longer term effort. I think there's a fundamental shift that's also required. There's a lot of talk and hype going on. But if you realistically look at even from the, if you look at what was committed for carbon reduction and what is actually being invested, there's a huge margin. I think that coming back, there are some models that I've presented here, but I think I want to I'm going to skip this in the interest of time. You can read these, but essentially, the idea here is that most of the time where you have small distributed generation or community power projects, there are some models out there that have been tried and tested, like this one that I'm mentioning, the YieldCo model. There is this model where you actually take on institutional asset-backed securitization. I think, again, Sandeep mentioned this. This is where he was mentioning that, if these 200 plus people get together and they pool their assets, and then, maybe it's easier for them to securitize and get access to cheaper funds. Green bonds, you already talked about. Again, this is about investor demand, how much supply is there in the market. But I think, again, let's come to the same thing as we talked about on the grid. Let's talk a little bit about the off-grid finance. So in our off-grid finance, essentially, for startup capital operating and end-user finance, we find that entrepreneurs and their equities can be secured. However, sometimes, yes, supplier credit, obviously, for good reasons, is secured. Occasionally, it's easier to find grants, sometimes bank loans. I mean, even in Pakistan, I can assure you that there are some small utilities working on bank loans, but they're struggling. And, they're trying to get out of that debt, and it is not viable unless you really jack up the tariffs tremendously. But I think let's talk about the gaps there. So there is really a kind of lack of business development support because this is a new area. But most fantastic is that it's a new area for us, yet it is not a new area for, let's say, Europe. And I was also surprised to find that in Fukushima, the post-disaster, Japanese are now fully committed to community power. And I think that that is an area which tells you that this is really the part of the future. So the other important thing is seed and early stage risk capital. I can tell you from personal experience. I mean, I opened up this company, Padarthavana. We've so far struggled to find even, barring some experimental capital that was provided, we are still now in negotiations with two very large, one product manufacturer and supplier and a utility to try and secure, this what we call early stage risk capital, without which it's very difficult to really go to scale. The lack of intermediaries, brokers, platforms to channel seed finance, appropriately priced growth capital is not available. Yes, on the off chance, there are some grants out there from bilaterals, like from Netherlands, from Germany, sometimes from even DFID and USAID, but those are few and far in between. I think the other, as you can see, that in this smaller market, the hedging of the foreign exchange risk becomes a Goliath, as opposed to the little, let's say, menacing fox that it is in the case of the grid finance. So that's again struggling because banks don't get it. They don't really understand. And I think that realistically, our feeling in this area is that unless the government provides an outright subsidy for hedging, or if not for hedging, then for actual, some sort of what we call a social fund, which covers the viability gap. Now, please understand that this is not asking for a lot, because I always give the example of trains in UK. Of the 17, between 11 and 17 companies that provide services in UK for train services, they still require viability gap funding because of the inherent understanding that the government owes mobility as a human right to its people. So here again, we have a very good platform that the government owes the provision of electricity, power as part of the seventh SDG and more to its people. So it's not something that's unheard of. It's not a large sum of money. But the point here is that without that, these kind of ventures, which are really the only way the government can, because let me just be clear, the offset, I already told you how expensive it was to connect to the grid. So by the time the government gets the grid there, so it's a huge loss of productivity. And if you do the economics and the numbers, it's much better providing this kind of funding. So I have basically, we assembled an overview of renewable energy tariffs. I'm going to skip this. There's a whole discussion on tariff and billing systems. What is the difference? What we've tried to assemble and show you what's happening at the grid level and what are the challenges. So, for example, and I think this is one slide where I think maybe I should spend a little bit of time, is that if you look at grid offtake, obviously these are mostly notified by regulatory bodies. And there's a huge, and if you want to feed in renewable energy, it's either by auction or preset fixed electricity prices. Yes, at some points capacity payments are made, which obviously are not good because they contribute a lot to the power sector debt that a lot of countries are struggling with, and Pakistan in particular. But I think that on the distributed generation side, you have multiple options, such as providing uniform tariffs, cost-effective tariffs, a hybrid tariff scheme, which is prevalent in Nepal, avoided cost tariff, which again Tanzania uses. And so the point is that I think the market, if you realistically look at it, that really is open for innovation, that is open with more possibilities, is the DG market in terms of attracting finance. I think one of the things that I will give you, I have put in the presentation some case studies where financing schemes and who's doing what, and I think it's important that I don't bore you with all this. So I think, Umar, with your permission, I'm going to stop here. But in summary, I think the important offtake message that I want to leave with the group is to essentially say that we need, from a SAARC perspective, to now start thinking not just of renewable energy financing, but actually looking at off-grid distributed generation renewable energy finance, where there's a much larger room to experiment, but there is less risk because the sizes of transactions are smaller, but can be aggregated to reduce the borrowing costs. So I think with that, I'll end my presentation. Thank you.
Thank you very much, Amir, for presenting a comprehensive case for mini grids. We have a few questions here. We'll quickly go through the questions. The first question is that what business model is used by Chinese solar mini grid projects that you mentioned in your presentation? Is it managed and operated by local governments?
Yeah, actually, this is true. So the Chinese being Chinese, right? I mean, and Sandeep kept saying democracy, democracy. Well, China also is a stable government, not exactly kind of democratic, but stability is one thing. But the Chinese model was very simple. It's a bit like they offloaded. Essentially, they allowed municipalities, localities, and communities and towns to essentially provide loans to set this up. And yes, the monies for the initial installation were provided through loans from the local councils, the local towns, or the local communities. So they end up owning the assets.
Thank you. So the second question is, I guess this question is from Pakistan. What is exactly meant by widening debt equity gap, and what debt equity ratio is more beneficial for our part of the world? In Pakistan power projects, a debt equity ratio of 20/80 is generally followed. So do you have any comments on the suitability of this ratio?
Well, I mean, let's put it this way. I mean, debt equity ratio basically is dependent on what the shape of the special purpose vehicle is. It also depends on if the debt equity ratio is, let's say, as he said, 2080. But if you look at the past projects that have happened, especially under CPEC, it's more like 2575, as you well remember, Umar, from the paper you did earlier. So essentially, that is depending on what is the government side of the game. How much of the debt comes from whom, and how is it structured? Now, from a actual project perspective, essentially the greater the equity, and if the cost of the equity is being plowed in by a patient capitalist or a patient investor, the more the equity, the better. That means you have more cash in hand. It goes. I mean, you can have longer payback periods. So I think this is dependent from project to project. So there is no one fixed formula for this. Depends on what the payout rates are, what the recovery rates are, how much what is the portfolio comprised of, what kinds of investors.
Dhwani Saab, thank you very much for sparing your time and for being with us today. It was a very, very useful and valuable presentation, and we learned a lot through this presentation. But my one question would be that you spoke about funding of viability gap. So, in what form and that too from the government, in what form and at what stage that funding would be required, and you are proposing or suggesting?
Yeah, so I think that this viability gap funding is a very old concept, and I think your question is very good in terms of you've asked like what form and when. So the answer is now, as for the when, because unless this is set up, other people are not going to help start taking the risk. Because the moment you go and you start, and we've been running a lot of these financial models, aggregating villages and aggregating utilities and seeing what makes sense. And if this is available now, it will just encourage more transactions. Now, in what form? The form of such a utility, I don't know if you remember, I think almost India, Pakistan, everybody at one point, and I think India gave up on this like in the late 90s, but Pakistan actually set up an infrastructure viability gap fund under the Ministry of Finance, which technically is now part of the structure that's been converted into the public-private authority, or whatever it's called, privatization authority. It's basically, the idea would be to pool a certain amount of money, keep it available for payments on the audited books of these utilities. So for example, let's say we pick up an area, it could be an area-based payment. So let's say we focus on a union council, or we focus on a district, let's say Chitral, and we have 50 utilities there that basically collectively are run by one aggregator, as Sundeep was saying. So that aggregator presents their accounts and says, after legitimate profit of 20%, here is our gap this time because of recoveries or whatever, etc., and has a good risk. Based on that third-party audited report, the government says, okay, you were short 10 rupees this financial year, here you go. So that's the form which such a viability gap fund would take. It would not disperse in the very beginning. It would be formulated, basically, it will be set up, but not capitalized, but not actually dispersing until the first cycle is done.
Thank you very much, Dhwani Saab. Again, it was a very useful, very valuable presentation, and we hope that you will be available to us in these opinions in future as well. Thank you, Dhwani Saab.
Thank you very much. It's a pleasure, and definitely any other questions if people, when they see the presentation, we are available on email. Thank you very much.
Thank you.
Thanks a lot. So, dear participants, now we move on to our third presenter, Dr. Rahul Tongia. Dr. Rahul is a fellow with Brookings India in New Delhi and member World Economic Forum Global Future Council on Advanced Energy Technology. His work focuses on technology and policy, especially for sustainable development. He leads the Energy and Sustainability Group at Brookings India and also is active in broader issues of technology. Tongye's work spans the entire gamut of electricity, with focuses on supply options including renewable energy, covering finance, grid integration, etc. It also focuses on smart grids, which use innovative information and communications technology to improve management of the electric utility grid, issues of access and quality, and broader issues of reforms and regulations, including electricity pricing. He is also an adjunct professor at Carnegie Mellon University, where he was on the faculty for a dozen years and was the founding technical advisor for the Government of India's Smart Grid Task Force. So with this, I let's move on to Mr. Tongya's presentation. Mr. Rahul Tongya, can you hear me properly?
Loud and clear. I've been listening to both the other presentations. Hopefully my voice is clear.
Yes, it's clear. You may please go ahead.
And can everyone see my slides?
Yes.
Excellent. So thank you for the invitation, and I'll try and keep it a little short. A few quick caveats. This is a personal view. Our institute has no institutional view. Second, I've modified the topic because the original topic I was told was to look at rooftop, but then I've added other financing issues as well. And third, I'm actually now going to try and step up from the details that were presented by the previous two speakers that I'd heard, which were very accurate about bonds and financing and multilateral modes of funding, distributed generation, and all of the above. So this is because if you as we all know, this small little congregation called SAARC is about 1.75 billion people. And even taking a country like India, which I will use as a starting case because of its vast size and heterogeneity, one size does not fit all. So there will be a little bit of generalizations. Before I really dig in, I will give my personal opinion, which slightly disagrees with Sandeep's point on should CDM be available for rooftop solar or other solar. And in theory, these gap funding or incremental funding, transfer funding mechanisms were meant to pay for that which would not get done otherwise. So if on one side we hear the statement that solar is the cheapest form of new electricity generation, then at that point, you would ask, why does this need such support mechanism? So that's a whole separate discussion. I want to focus a little bit about the economics and not just the finance, because from a higher level policy perspective, the fundamentals matter. And so there'll be a little bit of generalization, but I will open with another generalization, which is if any project, especially in energy, especially in renewables, makes sense, that means it gives a rate of return that's appropriate based on the risk profile, then the money is out there. There is no dearth of money at the global capital level, but getting it to the right places, friction, stickiness, regulation, these are some of the issues that I've seen as slowing down what would be the otherwise potential of these areas. So I've generalized as three types of photovoltaics: standalone, which is often flashlight or lantern single, or solar home systems. These are not interconnected with neighbors. Then you have grid interacted. People call them rooftop. In theory, it could be anything which is also called behind the meter. It could be in your yard. Now, does this connect to the regular grid or a mini grid, microgrid? That's a key difference which will apply differently in different places. India, for example, now has virtually 99.9% of households connected to the regular grid. This has been a focus area for this government for the last few years. And in the last 1.5 years after this new scheme called Saubhagya, they have actually done remarkable in terms of a wire to every home. Now, is there quality supply on the wire is a completely separate question, but at least the wire has been delivered. And the third sort of scale or type of solar PV could be a solar farm, grid scale, utility scale. And these are often tens of megawatts, if not hundreds of megawatts in size. Near where I am in Karnataka, I'm in South India, they have a 2,000 megawatt solar farm called Pavagoda, which I believe is the world's largest. So when you look at the fundamentals and the economics, the real question becomes, what are you comparing it to? Well, is it a candle? Is it a kerosene? Is it diesel, which is even used in some communities without traditional? For grid interactive, people have prices or tariffs that they compare it to. And now the question you want to ask yourself is it a consumer price that you want to compare to wholesale price? Those aren't necessarily the same. And then from a grid perspective, if they're choosing between gas or coal or hydro, any of the traditional sources, solar has to compete with the lowest alternative supply source, or you have to be willing to give it differential access to the grid or differential pricing, because it's not just pure economics per se that may be the criteria. There's a couple of nuances. For standalone systems, we found worldwide that there's a very high willingness to pay, including you pay per volume. It shouldn't be by volume. So the first few units, so if you just want to do lighting, charging your mobile phone, people are willing to pay 20 rupees a kilowatt hour, which they do today. But the total monthly cost is key. Often in India, a magic figure people talk about is 100 rupees per month per household is what they want to pay. Rooftop systems. Now, I'm talking about grid interactive, not microgrid. So are they expected to consume all, or do they send it back into the grid? When are they consuming and when are they sending back matters? Because as you would guess, solar's maximum output is in the middle of the day, while the grid often has a peak in the evening. A very fundamental issue is, are we comparing retail prices versus generation costs, or should we be comparing wholesale with wholesale? Is that an apples to apples comparison? I'll come back to this in a second. And then for grid scale, almost all numbers today look at only levelized cost of energy, LCOE. Sorry, that's a typo, LCOE. What about system level costs, grid balancing costs, impacts on other generators, time of day? These are things often missing from many claims which say solar is the cheapest energy and the traditional sources are dead or dying. Well, they're facing competition, good competition, but they're not quite dead. What is the solar output in the evening is a very simple way to challenge the premise of being cheaper. So India, as many of you may know, has ambitious plans of 100 gigawatts of solar, which is 40 rooftop, 60 grid scale by 2022. And the total targets of 175, which is 60 wind plus 15 others, lead you to a 25% annual CAGR required from 2015. Now, where are we? The total in India is now approaching in the order of 30 gigawatts. But yet, rooftop, as of December 2013, third-party estimates were only 3.3 gigawatts, so far behind, while grid scale is closer to 26 plus 27 gigawatts. So there's a good chance if they add 10 every year in 3 years, you could hit 60 for the grid scale. The rooftop is far behind. Now, I will not get into the fact that will they actually hit the targets. To me, targets are directional. Who cares if it takes 1 year extra or 1 year less to actually achieve a target? The growth rates are still very impressive. Last year, India, 2018, added the third highest PV behind US and China, and the year before it was the second highest behind China. So impressive growth. So if we consider rooftop, so the grid scale is pretty easy. These are often bid out, because they can be pushed. The central government or states put out a bid, they put out a renewable portfolio or renewable purchase obligation, and thou must comply, or at least that's the rule. And in India, rupees 2.44 per kilowatt hour used to be the benchmark. Rooftop, on the other hand, is very different, and the economics are very complex. It needs the consumer buy-in. Now, it's a separate interesting observation that Germany and California, solar is predominantly rooftop or edge-based. So the consumer value depends on their prices, but that's a retail price. That's not a wholesale price. If the electricity grid, the utility, could put up the same solar panel, let's assume it costs 2.5 rupees, 2.7 rupees, some number, They cannot sell that to the consumer at that price because they have fixed infrastructure cost, they have balancing cost, they also may need other energy forms that have to be blended in a portfolio to meet the demand for the evening or for when clouds come in. So these are not apples to apples comparisons. Plus, consumer prices may have distortions. I don't know for Pakistan, Bangladesh, Nepal, and other countries, but in India, the commercial and industrial or C&I customers pay more than the cost of providing power. They cross-subsidize other consumers. With this reality, guess who's going to be the first one to put up a rooftop solar? It's going to be the so-called paying customers, which is the C&I, commercial industrial, plus maybe the large residential consumers who have tiers or slabs with telescopic tariffs, meaning higher tariffs. I'll show an example in a bit. So some of the fundamental challenges from a policy or high-level perspective for rooftop is it's a very fragmented market. For grid scale, we have leading providers which are 1,000 megawatts plus in scale. We have multiple global players, Indian players. You've got, Renew Power, Wari. You've got in Tata Power. Then you had at some point, now it's Aveda. They used to be Wellspun. There's a number of companies who actually supply. Small scale is a lot more fragmented. There are a couple of players, but they focus not on residential, but mainly commercial or industrial or institutional, such as schools or government buildings. There is an issue of quality concerns because India, like many countries, is very price sensitive. So the lowest cost is often done at an extreme level, maybe by changes in the spec. Lower plant load factor or capacity utilization factor is a reality. There are no good data, at least that we know of, aggregated. One is it's very hard to get the data from a lot of distributed sources. And second, maybe people don't want to share. Anecdotally, we've talked to developers who have told us that in a city like Delhi, you get below 15% load factor, while many large grid projects, especially now with single axis tracking, which is rarely ever installed on rooftop, they're getting over 21% load factor. Cleaning and pollution are part of the problem. There are other risks. So with rooftop, you are subject to the whims of what your neighbors do because they could put up a taller building, plant a tree could grow. Then what do you do? The other challenges are zoning norms. So for example, in Mumbai, they limit how high you can raise a solar panel because if you are allowed only 3 stories high, they don't want other structures growing too much higher than that. Plus consumers are worried about losing their otherwise useful for multiple uses empty roof. So when we look at the economics, mini grids or microgrids, what people talk about, these are often thought of as solutions for villages, but in some countries, it's a household problem, last mile challenge. At least till recently, till 2 years ago in India, the grid had reached every village. It had not reached every household. So then it's a last mile problem, which still needs an infrastructure. A lot of the microgrid developers perpetually had a fear, will the real grid come and then disrupt their operations? No government will tell a region, hey, you're going to be the last to get grids connection because politically that's untenable. So there's a lot of uncertainty in which areas should be prioritized for mini grids and microgrids, which are very valuable solutions, especially for a few years, 5 years, maybe longer, but not necessarily 20 years, which is in some ways the lifespan of some of this capital equipment. It's important to recognize that almost all costs are fixed costs. Yes, there's some O&M, maintenance, metering, bit management costs, but solar plus a battery are fixed costs. So then sizing it right to have headroom for growth, to allow for bursts of demand, seasonal or otherwise, is very, very problematic. While the traditional grid, even if it appears expensive, it allows a lot more headroom. People talk about cheap solar. So if grid scale is 2.5, people say it's 4 for village level solar deployments above a certain size. We're not talking tiny house, but village level. But your actual costs are much, much higher because your battery costs will dominate, as well as the fixed infrastructure because you need wiring and ideally some metering, plus even management. So cheap solar has helped a lot, but it doesn't quite solve all the problems. The bottom line is if the usage per month is low, the per kilowatt hour costs will be high. This is true for a mini grid solar, and this is also true for the regular grid. And this is probably the most fundamental thing that policymakers need to understand. So what's holding it back? Is it the fundamentals and the economics, lack of roof space? Is it lack of policies, human capacity, quality, finance, awareness? It's probably all of the above, and that's why there's no one fix that if you fix this one problem, all of it will happen. This is one of those things that will scale inevitably, but not as fast as some people may think. However, it's interesting to note that in the last 1 year in India, the growth rate of rooftop, of course, from a very small base, was 66% higher than the previous year, according to studies by analysts like Mercom. So how does it work if I put up a rooftop solar? The zeroth order is if I'm disconnected from the grid, I have to use up all my solar. The solar has to match my demand or vice versa. And if it doesn't, I either throw it away or need a battery. In contrast, you could actually interconnect with the grid, and that led to the concept of net metering. So one of the first policies for this was in 1978. PURPA in the US mandated that utilities have to buy back power at their avoided cost. Now, this, of course, was subject to interpretation. What does avoided cost mean? In India, like the US, there are state-to-state variations in how to handle net metering. What are the size limits? What are the pricing, etc. Some of the net metering is actually a loose term. Is this for gross or net feed-in? Because the more a consumer uses in-house, the less they will feed in. And then the question is, once they feed in, at what rate are they paid? Is it a flat rate? Is it a generation-based incentive? Is it a feed-in tariff that's flat? Or does it depend on the consumer's price? Now, if that latter part is true, then what that means is solar is most viable for people with high costs, i.e. commercial and industrial, or large households paying larger than average cost. So your best customers are the first ones to exit the grid. But that's not quite true. They don't exit the grid. They reduce their kilowatt hours consumption from the grid, but still come back to the grid in the evening when solar's output is zero. So technologically, we have to understand where and what type and when are the measurements. In the simplest world, your meter spins backwards. What that means is the consumer gets paid only equal to their marginal tariff. Now, it's a different question. What happens if they spin backwards more than their consumption? Do they get banking? Do they get a carryover? How much do they consume in-house will vary, weekends, weekdays. Now, the economics are of two sides. From the consumer, the cost is a capital-heavy cost. We assume that they clean it for free and have a cheap maintenance system. So now they will just say, what is the electricity out of this solar system? And what was my grid alternative? But the utility has the other challenge that's saying what happens to their marginal costs and marginal revenues. Another niche, will they have a battery? If they do have a battery, that's expensive for consumers, but it also can allow them more security because some people want solar power or backup power to provide quality when the grid fails, which in some parts of the world, even in India, is still non-zero. The load shedding, as it's called, has come down, but it has not yet gone to zero. What this requires is a grid tie inverter that has isolation properties. Traditional grid tie inverters were set up such that when the grid fails, then you have to switch off the inverter because you can never have backfeeding. On the other hand, what you want is something that can isolate the system and still continue operations because you want the solar panel to continue operating even if the grid is down. So these raise the costs, and of course batteries raise your capex. It used to be 70 to 90%. As solar's costs fall quicker than battery costs, at least in the near term, for the scale of batteries these will use, the battery costs could be even higher than just this much compared to pure solar. You also have, of course, efficiency losses for the battery. So the fundamental questions are, where do you put in the meters? That links to what is your payment scheme. How is a meter capable? One is, in the oldest way was, of course, spin backwards. The second way is you have separate import and export registers. So how much electricity you don't want to measure just the net. You want to measure separately outgoing and incoming electricity. One of the changes this requires on meters is how they view theft or tampering, because in many traditional systems, any negative flow of power was a sign that possibly someone is reversing wiring or bypassing part of the wiring or the neutral phase bypass. So tamper technology on the metering needs to be updated so that this isn't viewed as theft. There's other challenges, which is, can a third party own and deliver the electricity? Because electricity in many places is regulated. So the consumer may be allowed to set up a rooftop, but a separate company cannot without having a license as a generator. Even if they wanted to be a third party generator, leasing or renting someone's roof, or even just giving power from that roof to the owner of the roof. There are also some differences. How do you want readings to be taken? Is it digitally versus automated meter reading or advanced metering infrastructure or a fully smart meter? Where do you meter? I'll show a graph. So you could have an inverter after the solar panel, which then feeds to the grid, and you obviously would want to meter that. Or you could feed before the grid, meaning inside the house. Now, we have not shown the meters, but if the first one is gross and the second one then becomes net, the lower one, because in the second one, some of the solar is going to be consumed in the house and the grid will not know about it. The only thing the grid will learn is, hey, this person's consumption decreased. They will not know or have visibility unless purposefully designed whether that reduced consumption was due to the person being more energy efficient, changing their demand pattern, or actually having distributed generation. And of course, we don't know if they would have a battery. If you now say that I'm going to give you a differential tariff that's very preferential, then the worst case would happen if someone wants to game the system by not using solar, but using subsidized electricity to charge the battery to feed in tariff at a higher rate. That's the extreme case of why utilities are wary of consumers having a battery and yet taking advantage of these schemas. So one segregation could be gross metering versus net metering. So in gross metering, the total generation is measured, and then it feeds to the grid, and then some of that may come to the consumer, and then they just have total consumption measured for the individual. On the other hand, if you're doing net metering, you would want a ideally bidirectional or gross meter at the inverter level. Why it's bidirectional may also be important, because if you have a battery and then that battery is connected to your house for backup power, and you need a bidirectional import-export meter for net metering. So this is something where rate designs have to be in sync with the technology, with the policy, and what the consumer's expectations are. In India, there's no single policy. Some states have capital subsidies, some states offer generation-based incentive, some offer a gross generation-based incentive, some offer a feed-in tariff. You have other mechanisms such as solar portfolio obligations, a subset of renewable portfolio obligations. You have Haryana or Chandigarh, which have mandatory rooftop solar for consumers above a certain size. Of course, the enforcement is very weak. You have technical specifications by statutory bodies, and then, as I mentioned, other restrictions like on construction. One of the major problems with a system where you conflate retail and wholesale prices leads to what some observers call the utility death spiral. So as consumers put on rooftop solar, this reduces the utility revenue. Once it reduces the utility revenue, but their cost structures, for example, the fixed cost, capital costs, or capacity requirements of generator to meet the evening peak are the same, then the utilities have to raise the rates. Once the utilities raise the rates, more people say, hey, I either should be more efficient or I should seek other ways other than the utility, whether it's solar rooftop, third-party sales, edge-based. People are talking of blockchain transactions, peer-to-peer. There are many different ways they could start to reduce their utility costs. So once the utility utilization, so that raises the rates, which makes more and more people do this. So this has been called the utility death spiral. But in India, you have an additional distortion, which is not just due to renewables, but also you have theft and tiered slabs. So the first people who would consider exiting the grid are the ones who disproportionately pay for the utility. So where's the conversation, at least in India? There is almost no discussion today on smart inverters because everyone says it would cost too much. It would cost more, but it would give savings to the utility, and we don't have frameworks yet to incentivize the consumers to put in smart inverters that could give reactive power support, for example. If you did do this, you could have almost no limit on how much solar is manageable at a distribution transformer level. You would have more local stability when you have bidirectional power flows. So today, if you mandate it on the consumer, they would grumble because it raises the cost. So there needs to be a payback mechanism from the utility perspective, which finds benefits such as improved reactive power and voltage stability in the distribution network. We've already mentioned how solar today is mostly use it or lose it, or variable RE, VRE. So many consumers end up using the grid as a battery. So the question becomes, what are the policies for banking? Do they get back power given in the day, you get it back in the evening for free at a notional cost, or do you get differential rates based on time of day? Most countries in SAARC most utilities that I've seen do not have time of day pricing for retail consumers, except in niches, either voluntary or for very large consumers. So this is an evolution of the grid that is ongoing, independent of renewable energy. PLFs, of course, matter. And where are the yield co's or the rescos? We'll come to this in a second. There's a good report. Some of you may have heard of Rooftop Solar Policy Coalition, where it really says that the policy wants to achieve 40 by 2022, but yet the policy, the practical technical policies at an operational level are not there yet. And so we're not on track to reach the targets. So this has a lot of recommendations on things like soft loans or quality checks, warranty, partnerships, etc., that are really needed to scale these technologies. So from a consumer perspective, they just ask, what's my cost versus benefits? It depends on my the scheme and my slab or tariffs. And then there's also this issue of why not wait? Because prices are always falling. True, but by that measure, you would never buy a mobile phone or a PC because it'll always get cheaper a few weeks later or a few months later. There is this question of what else could I do with my capital? And this is an area where people's imputed cost of capital is often very high compared to viable hurdle rates in energy systems, which are often in the 10 to 14% range. People implicitly sometimes have a 15 to 20 to 30% discount rate. From a utility perspective, what happens? So I spoke to someone late 2017 who had installed a 6 kilowatt system on their roof, no battery, and it cost 2.83 lakh, 283,000 rupees after the 30% capital subsidy. The net cost, well, they did the math. They said, this is my interest rate, I'm assuming. So I said, you should use a low interest rate because this is very low risk. You're actually saving money that you would pay to the utility. So you actually have a good cash flow or opportunity cost cash flow. And so using such a low discount rate, then the electricity from this system costs them 4.5 rupees a kilowatt hour post-subsidy. Even without a subsidy, their tariff was over 7 because they were the so-called paying customer, the large household. So first question is, why would we have subsidies for the rich? 2018 numbers are now 25% lower even. So it's viable for some consumers, but that assumes it works on time and continuously, and they benefit from free banking which in their state was within the month of giving and taking back. So challenges include bidirectional meters are needed. You have economic challenges we've already discussed. Germany, people tout as a classic success story. It is very, very expensive. They are paying an EEG surcharge to cover the costs of the feed-in tariff that were promised years ago. So I think the whole world owes Germany a debt of gratitude for getting volumes high and bringing us down the learning curve. But they're paying much higher than most other countries for this EEG charge. If we have an unstable electricity grid, you have to make sure you have a hybrid inverter that doesn't just switch off, but it disconnects and keeps running when there is a grid failure. And the inverter technologies, it's very hard to update remotely technology of meters. So Hawaii was the prototyping for smart inverters. That should be considered. Policies need to be in place, not for a small niche microgrid, but when we do urban areas, especially richer urban areas, utilities need to plan for such futures. The business models, obviously economics aren't alone. We can appeal to people's social responsibility, corporate social responsibility, or their vanity, that people can give signaling that, hey, I'm green. There are a lot of changes in business models. You could also, for example, offer credits to households that if they put rooftop solar, you will be allowed to grow more constructed area. So the floor space index or floor area ratio could be improved, but that's a public policy level question at a city level. Wind grew in India very first because it was very simple. All an investor needed to do was, here's my money, and someone else, the operator and builder, would run the system for them and give them money. Solar is not quite there yet. We don't have enough, at least in India, players who will just say, hey, I will put this somewhere. Utilities don't want this done in third-party locations. They will allow this today mostly for behind the meter. So now rooftop space becomes a key constraint. More financing options. It's now being allowed within mortgage funding, and mortgage debt is cheaper than other debt. Yieldcos we've talked about, which are the RESCOs, the investors we've heard about who will put this out as a separate product and get a sort of smaller rate of return. It's like people who want a rental on a property instead of a resale. So the builder will build the house expecting to sell it, but someone who buys it for getting a yield is like a REIT or a yieldco. So patient capital doesn't mind a lower rate of return, but they want risk. So one of the problems we've seen in India is, what if they invest, but they don't get paid? So they make an agreement with a household, and then the households are supposed to pay them back every month based on the output. So let's say they don't get paid. The first thing the yieldco or the RESCO would do is, if you don't pay me, I'll switch off the solar supply. Fine. So that inconveniences the consumer, but they would still go back to the grid. On the other hand, the RESCO is out of money. What also happens if they don't clean? The RESCO does not want to actually deal with having the end consumer clean, because they may damage it and the end consumer may not do a good job. But do they get access to the roof? The last problem is consumer risk profiles like credit ratings. So one of the new innovations people are talking about is bringing the utility on board as a partner. So now getting a tripartite agreement where if the RESCO or the yieldco is not being paid, then the DISCOM or the distribution company, the utility, could actually cut off supply. This is interesting, but it's an issue of fairness as well as, will the regulator allow such a agreement? Some recommendations. We've already discussed most of these, including non-financial instruments. We have to make it attractive, which is more than just the financial attractiveness. And the future, that last two slides, we cannot think about the future without ignoring other changes like storage, electric vehicles. Time of day tariffs will also become technology. Good news is, of course, the technology is improving disproportionately. Last slide, I think, on grid scale finance. We've already heard, so I won't go into what does green finance mean. Is it just that it's designated or advertised? Is it just signaling? Or is there also a lower cost of capital? What are the risks is what it boils down to. The biggest risk, at least for India, investors have said for grid scale, is counterparty risks. Poor cash flows of the utilities, they delay payments. Even if you've got a watertight contract that says we will pay you or you can sue us, nobody actually wants to sue them. Because what else will you do with your asset? There have been attempts recently to renegotiate PPAs, power purchase agreements, between utilities and renewable providers, partly because new solar is always cheaper than old solar. That creates perception problems. And recently you've had problems where bids have been canceled because they didn't meet a perceived threshold, such as 2.5 rupees a kilowatt hour. The ultimate aim is cheap global capital. Pension funds, sovereign funds, they're willing to take a 1% rate of return, 1.3, but that's often in USD or euros. Foreign exchange hedge is very expensive. And what these investors worry about is first governance, second predictability, and third returns, in that order. So rate of return isn't all that we need to focus on and make it cheap. It's actually the other parts as opposed to just economic viability. What can the government do? I think we've already heard this from Sandeep on financing. It's not just exit, but turnover of cash. Different capital is best suited to different stages of a project. It's only after the operations and secure cash flows would we move to low-cost global debt. So the upfront capital is high risk, needs the higher rate of return, and then we get the rollover to intermediary, and then the ultimate patient capital, long-term 25-year 23 years by the time you get to them, sort of capital investments. So these are the stages at which we need investment. And part of the problem is governments have been trying to get patient capital to give upfront money to grow the asset base. That doesn't scale very well. So solar and distributed are already here. People think sometimes these are niches, but a niche in SAARC is going to be bigger than a country in Europe. Thank you.
Thank you very much, Dr. Rahul, for your very, very comprehensive overview of the grid connected as well as solar rooftop project, especially in the context of India. Our conditions in Pakistan, they are a bit similar to India, so it was a unique perspective and it helped us understand the market situation in India as well. So we have a few questions here. One question I presume is from Pakistan. It says, normally in nations with demand supply gap and which experience load shedding, to my knowledge, the problem arises that the grid connected rooftop solar of a consumer may not supply electricity to the grid during load shedding. So how do you look at this problem and how to tackle it if that is so?
This is absolutely a feature. It's not a bug. And by that, what I mean is it is for safety reasons that if the grid is down, that you should never have power flowing into the grid at an AC up level. Because if somebody is doing a repair, somebody is doing maintenance, or they just assume it's down due to a load shedding, as it's called, then that's a severe safety issue. So by norm, by specification worldwide, they have to disconnect. Now, the easiest way traditional inverters did that was disconnect means switch off, because that's works for most of the grid. Why would it switch off? It's only rare in most countries. It's not. Most countries did not have 1, 2, 3 hours of outage every day. So that was fine. What we need and have available on the market, but you have to ask for it, the newer generation technologies, which are hybrid inverters, which can grid isolate, not switch off, and feed into the isolated household or end user.
But I guess the hybrid inverters are like 2 times more expensive, right?
I don't have newest pricing information because I'm told it is no longer nearly as expensive as it used to be. Plus, you have to ask yourself, the the isolating inverters are already available because a lot of households have battery and inverter as their backup. So forget solar, forget diesel. Diesel is a very expensive form. A lot of upper middle class in India have a battery with an inverter. This inverter is already wired to be grid isolating because this inverter must never feed in. That is why you only get, in many of these homes, only specific plug points or locations, partly because of load limits, capacity limits, but also for isolation limits. So anyways, houses have to take that effort for phase-wise or circuit breaker level-wise isolation of these circuits. So yes, there's a cost. I don't think it would end up being 2x by any stretch.
All right, thank you very much. One more question. You mentioned that LCOE for solar might be very attractive, but the hidden costs such as grid balancing costs aren't factored in. So, do you have any estimates for Indian grid connected solar projects regarding their overall LCOE while considering all the system wide costs?
There are no good numbers because they vary so much based on what the rest of your grid has. The only official number is a study by the Central Electricity Authority, CEA, for 2017 when it had come out, I think in late 2017, um, where they had estimated 1.5 rupees a kilowatt hour for two RE-rich states, Gujarat and Tamil Nadu, which was a combination of the higher costs of RE compared to the variable costs of thermal. So this assumes you have enough thermal energy, or coal, for example, in India is the swing or new incremental producer. So once you've built the coal, then adding a new RE would compete with the fuel of coal. Or you have to change the output of the coal, which means run the coal at a reduced plant load factor, or to change its output up and down, or it may be transmission upgrades required. Today in India, in fact, just last week, they announced 25 years free transmission on the interstate transmission system for solar power projects. So other generators could ask, why don't we get this? So clearly that's a hidden, if not cost, but then a subsidy or a differential. So all of these put together were estimated at 1.5. The good news is the cost differential of fuel, marginal cost with coal, is reducing because renewables are getting cheaper. The bad news, and this is true worldwide, is the initial renewables cost balancing is very low because you can absorb it as is. Once you cross a certain volume of variable renewable energy, not where we are today, but we're talking tens of percent, then the costs skyrocket, and at some point you may need storage. So at that point, the costs become even higher. These are things that different countries have to work out based on their own grid.
My question would be that this storage issue are advanced countries such as Germany, because they have very high penetration of renewable energy. So, are they working on this storage capacity enhancement as well?
I think most countries operate a portfolio solution, which is we'll use whatever makes sense. So storage is one tool. Now within storage, we have to remember that pumped hydro is actually the dominant storage technology for grid scale. It's 120 gigawatts plus. Batteries at grid scale are vastly orders of magnitude lower. On the other hand, you also have demand response, grid shifting, many other techniques that can help balance the grid with variable supply conditions. The other thing to remember is batteries, which get a lot of the newspaper and mind space. Their real value today is either in automotive or transport because you're comparing it to more expensive fossil fuels, or for the electricity grid, storage has immense value when you look at small uses like ramping or frequency support, ancillary services, things like this, where the volume isn't very high, but you need very fast response for a short amount of time. So storage makes immense, batteries even are viable today. batteries are not there yet when you say, I want to shift 4 hours out of 5 hours of solar production, or 80% of solar, I want to shift it to the night. Batteries are not yet cost effective to that, at least based on comparing with traditional fuels without carbon taxes.
That's a very well point. Thank you very much. In connection to the very first question that I asked, the questioner has sent in another comment. He's saying, but from consumer perspective and also from distribution companies' point of view, is there any sub-grid level solution to this problem, since this is the high time to encash this facility? I hope you
Sorry, can you
understand.
clarify which problem? I mean, there's many problems we've discussed, so sorry, which problem?
Yeah, so regarding the very first question which we asked, the problem of that the solar cannot supply to the grid when there is load shedding, and you proposed that there are hybrid inverters available. So in regards to that question, there is an additional question that from distribution companies' point of view and from consumers' perspective, is there any sub-grid level solution to this issue, since it is the high time to encash this facility?
I think by subgrid, I think you mean distributed or small scale, in which case it may not be just a technology solution. Obviously, hybrid inverters are one tool, but if we actually have management systems or energy services companies, they would be able to better balance it. So if you can schedule outages, which are planned outages or scheduled load shedding, to sync with when renewable is more available, or you could also shift your demand periods, do demand aggregation. You would size your solar facility such that most of the time you don't need to feed it in, because in general, the best use of solar is when you don't need to either store it or when you don't need to take it in and out of the grid, because otherwise it becomes a burden or a financial potential hit to the utility. So right sizing it, keeping it dynamic and controlled, using storage or thermal solutions within a house. So for example, pre-cooling air conditioners. So this is now getting into the realm of smart systems and smart grids as well. So the future is really going to be all of the above. The one big storage technology that we haven't mentioned yet explicitly is electric vehicles. Not today, but eventually. How soon is TBD. These are going to become enormous batteries that can not only supply to the grid, V2G, vehicle to grid solutions, but even just the fact of choosing when you charge a car or vehicle is itself acting equivalent to a storage system for the net, for the grid. That's like hydropower. It's not only that you could run pumped hydro, but you could turn it on or off. You could say, I'll run hydropower now, or I won't run hydropower now. It's free storage in there as well.
All right, thank you. One more question. It's a longer question, so please bear with me. The question is, how will you cater to the commercial sale of electricity from the long-term power purchase agreements which the governments have committed in take-or-pay arrangements? Don't you think that if rooftop installations increase, the IPP-based electricity sale will decrease? And in this scenario, operators in future, I believe, will try to put a limit on the number of installations of solar rooftop. So, do you have any comment?
I think there are two different things going on. It's a very interesting question, and it's not clear if they will conflate. In the sense, you first got this whole issue of rooftop solar impacting grid scale solar, and then the discoms limiting the rooftop. So the discoms may want to limit the rooftop not because of their PPAs, but for the other reasons we discussed, like the utility death spiral risk. The competition between rooftop to IPPs or farms, solar farms, isn't as direct. And plus the volumes are relatively low thus far. So as long as these are small, utilities are even willing to blend it in, or what they call socialize such costs. It's, I always joke, if you eat too much of an appetizer, it becomes your main course. So as long as the volume is small, it's not a problem. But if you actually had both of these growing very high, then yes, that becomes a higher risk. But you will always have a price spread between the LCOE, levelized cost of energy, of a rooftop being more expensive than a grid scale system, not just due to economies of volume, but the plant load factor differential, and as well as cost of capital risk differentials, because people who provide capital prefer bigger projects because their due diligence efforts are somewhat similar. So that's one of the reasons cost of capital is also a difference between projects.
All right, Dr. Rahul, thank you very much. We are done with our questions. Thanks a lot for your very, very comprehensive presentation, and we hope that in future we could also collaborate in our future activities.
My pleasure, and I hope you can share my email address. Folks are welcome to reach out to me anytime.
Thank you very much. We will do that.
Thank you, everyone.
Okay, dear participants, with this, I may like to conclude our webinar. Thank you everyone for attending today's session of the webinar. We had listened to some excellent presentations delivered by our distinguished presenters from member states. All the presentations will be available on SAARC Energy Center's website very shortly. We would love to hear from you regarding any suggestions and comments for further improvement. Moreover, if you have any questions which you want to direct to any of the speakers, we would love to have your questions. Thank you once again for joining us today, and we look forward to see you next time again. Goodbye.